Value investing is a well-trodden investment path, but not all value investing is the same. During his video, Alastair Mundy, head of Investec Asset Management's value team, will discuss a contrarian value investment approach and how it differs from other strategies in the market. A focus on identifying out-of-favour, good value investment opportunities and, crucially, in-depth balance sheet analysis is what sets Alastair and his team apart. Alastair Mundy is head of the value team at Investec Asset Management, having joined in 2000 from Morley Fund Management. Alastair manages a number of funds, including the Investec Cautious Managed Fund and the Investec UK Special Situations Fund, both of which feature on the Tenet Fund panels. Alastair graduated from City University in 1988 with a bachelor degree in actuarial science. Following this video, advisors should be able to understand contrarian and value investing. In addition, understand the role of balance sheet analysis in constructing portfolios which contain a diversified basket of quality out-of-favour stocks, which ultimately offer the potential for long-term outperformance but with lower volatility.
So what is contrarian investing? It's hard to generalise about contrarian investing, but usually contrarian investors are searching for stocks which are out of favour with the wider market. What they're really looking for is those stocks which are most likely to bounce back, that have had a bad couple of years, but have got something intrinsic within them that means they're likely to be recovery stories. Sometimes contrarian investors are looking for recovery stories in a couple of months. Sometimes they're looking for holding periods over a couple of years. What all contrarian investors will be looking for, though, are cheap stocks. It's not just good enough for the stock to be out of favour. Think back to technology companies which were out of favour in 2001, 2002. Many of them went down 80, 90 or 100% even after they'd fallen very significantly. So they've got to be cheap and they've got to offer significant upside potential. However, not every contrarian investor uses the same approach. You won't find just one contrarian Bible out there that explains to you how to be a contrarian investor. Everyone brings something slightly different to the contrarian party. Lots of people often ask, how does contrarian investing differ from value investing? And I think one of the major points is that contrarian investing is more behavioural. We start by looking for those stocks which are most out of favour, i.e. those stocks which have fallen in share price. Whereas value investors often start from valuations, i.e. looking at those stocks which are cheapest, have the lowest price-earnings ratio or the highest dividend yield. We're really focusing as contrarian investors on those stocks which are causing other people and other investors most pain. So to put that in numerical terms, any stock that we look at and consider buying and to go overweight in, those stocks in the UK market would have had to have fallen at least 50% relative to the all-share index over the last 7 years from their peak. What does that mean in real terms? If a stock's fallen 50% from relative to the all-share index over the last 7 years, and they're in the FTSE 100, typically they'll be on the 10 o'clock news. There'll be a bank, or there'll be a retailer, or there'll be an oil company. Something really bad has happened to them. And typically, other investors will be saying to us, what are you looking at that stock in for? You must be crazy. So we're really trying to focus on that out-of-favoureness. At the same time, we're not really looking to buy or even spend time analysing those companies which could go bust or bankrupt within a couple of months. We're not really playing with distressed equities, as we call them. We're looking for high quality companies that just are very, very significantly out of favour, but will still be around in 5-10 years' time. And we're really focused only on the FTSE 350, the largest 350 companies in the UK market. Why is that? You'll find other contrarian investors who focus on smaller companies. For us, the simple truth is we don't think we're very good at investing in smaller companies. What we really love is to access information. We love it when we understand why a company is out of favour, why it might come back into favour. Smaller companies, it's much, much harder to access lots of information, and therefore we've found we're not so able in that area. And we've found over the years we still get plenty of opportunities within FTSE 350. What we'll do, because we're looking at stocks that have fallen over a 7-year period, and this is a continuous process obviously, is that we'll buy lots of different stocks at different times from different sectors. So we'll get a lovely mix of stocks over a whole portfolio, and we'll go into that in more detail later in this presentation. But I think this focus on larger companies really sets us apart from many other contrarian investors, or some people who call themselves special sits investors, often focus much more at the smaller end of the market. Good luck to them. We're not saying it's not possible to outperform there. We're saying we prefer to focus on medium size and larger companies. Our investment philosophy is premised on the fact that fund management is very difficult. Unfortunately, there's lots and lots of investors out there trying to do something very similar to us. They've got loads of information to access, and they're all typically pretty intelligent. So I think to believe as an investor you can do something because of your intelligence or because of your access to information is a little bit crazy. I think the playing field is pretty level. Therefore, what have we got to do? We've got to try and only play when we think the playing field is less level. What do we think is our best chance of finding those conditions? We think our best chance is really focusing on when clever people do dumb things. And the good news is clever people do dumb things all the time. We do it in our social lives when we're having arguments with our other halves or with our kids or disagreeing with our pets. We act in a sort of knee-jerk way. We don't think about what we're doing. We try and solve a problem very quickly. And it's not necessarily the best solution to that problem. How does those feelings of dumbness and irrationality play out in the stock market? It's often when you've got a stock on the portfolio which is falling. It's embarrassing you, humiliating you. You're getting pressure from your boss. You're getting pressure from your colleagues, they're laughing at you or smiling behind your back. You're getting pressure from your clients asking you why you're holding such a dreadful stock. And the easiest thing to do at a point like that is the knee-jerk reaction of just selling that stock, and therefore you can say to your boss, I don't hold it anymore, boss, or to your client, I don't hold that stock anymore, but all the other stocks in the portfolio are fantastic. That's really where we come along. We say, well, that knee-jerk reaction might be right. Just by luck, it might be right to sell that stock. But quite possibly, you need to think about it in a little bit more detail. And we come along at that point, not really knowing the company very well, not really knowing beforehand why the stock's performed quite that badly. And we're trying to be as objective as possible when everyone else is being as irrational and subjective as possible. And if we can just simply look at the facts and leave the emotion completely out of the picture, we think we've got a very good chance of making that playing field less level than it was. So let's look at our investment process in more detail. As I said previously, the first thing we want to do is focus on those stocks in the FTSE 350 that have significantly underperformed. So we run a very, very simple screen. The shares in the FTSE 350, how far have they fallen from their peak over the last 7 years? It's something, frankly, my mum could run. We then list them in order of those that have fallen most, almost down 100%, all the way up to the ones that have been best performing, and we're focusing on those that have fallen between -50 and 100%. And over the years, we'd have looked at a lot of those stocks previously. It's quite a slow-moving screen, so from month to month, you wouldn't expect to have many stocks either joining that screen or leaving that screen. So a lot of work will have been done in previous months or even previous years. What will that work entail? Well, we're really looking to write in-depth company notes on each of those individual companies. An in-depth note for us is about 10,000 words. It really looks in great detail at the company, and it's got a long shelf life. We could write a note and it could hopefully last us 3, 4, 5 years. It's not really looking at the day-to-day changes in the company. It's looking at much longer-term trends. So, and in every note, it's not a note that everyone writes in exactly the same way. We've got a team of 11 analysts, but they all have their different ways of writing notes. But they're asked to cover the main points. The first point is really to try and understand what the company does. How does it make its turnover? How does it make its profits? How does it generate cash flow? What does its balance sheet look like? Do we understand it? You know, if we don't understand it, admit it and move on. Some companies are just very complicated. There's not a prize in investment markets for complexity. If you don't get it, if you don't understand its accounting, move on, leave it for someone else. I always say fund management is great. You don't have to answer every single question. It's not like an exam where you have to answer all 40 questions. So if we do understand what the company does and we're comfortable with that, the next question is to say, what's the conventional wisdom surrounding the company at the moment? i.e., why is it so out of favour? What's it doing wrong? Is its share price falling? Is its management considered terrible? Are there things happening for this industry which suggest it's in structural decline? Or look at all those issues. Don't try to ignore them or avoid them. Embrace them and say, are they genuine problems that we should be concerned about? Are they very short-term problems that will be forgotten about in 3 months' time? Or are they problems that could be easily solved? Or, in fact, are they just not problems at all? Have they been analysed perhaps incorrectly? So we really try and consider this in detail. Where do we get this conventional wisdom from? Well, beautifully for us, it's everywhere. Because if a large company is out of favour, everyone will have suddenly become an expert on that in terms of wanting to tell all their readers why a company's out of favour. So we can read a lot of investment bank research, we can read the newspapers, report and accounts. We can really get a huge amount of information on it. We then ask ourselves, how can we oppose the conventional wisdom? So, as I say, we look at the negatives and say, how can we oppose the negatives? But we also try and think about the positives. And to find the positives, we go back 3, 4, 5 years and say, why were the smart people we're competing against, why were they buying these shares back then? They must have been looking at some very positive factors which they thought were going to drive those shares much, much higher rather than much lower over the next 4 or 5 years. So we go back to those points and say, how many of those are still relevant and could still drive the shares from their much lower level now? So to do that, we go back and read investment bank research, which is much older. And we can find that easy to come by. Lots of stuff is written, lots of it's kept. And we try and once again remove the stuff that's out of date and really focus on the longer term stuff, which is still highly relevant. The next thing we do is scenario analysis. I think what a lot of investors fool themselves on is that they can forecast the future. We're not astrologers. We don't know what the future's going to hold. We're more detectives than historians. We're trying to piece the past together and have an accurate understanding of that. And then we're trying to really guess what's going to happen in the future. So rather than really focus on one outcome in the future, we focus on a large number of different scenarios. And we say to ourselves, if those scenarios plays out, what could the shares be worth under each of those scenarios? And just as importantly, is the company's balance sheet strong enough to support the company under those scenarios? So if it's a really bad scenario, think about banks 4 or 5 years ago, under some of the most negative scenarios, were the bank's balance sheet strong enough, or would they have needed to recapitalise, i.e. would they have needed to issue more shares? So we always have to look at the worst case scenarios and ask ourselves whether the balance sheet's strong enough for that. We're not looking for brilliant balance sheets. We're just looking for balance sheets that are strong enough to get us through to better times. So at least if you start with a decent balance sheet, then at least the company's got a few years to try things out and try and recover. We don't want to be in a position where the balance sheet is so weak we've got our fingers crossed for immediate recovery. That's much, much harder. And the final point we look at is valuation. Are we being compensated for the risks we're taking? Because whenever you buy anything, there are downside risks as well as upside risks. So what we're trying to do is make an assessment of fair value. What is our assessment of fair value? How do we get to that? Well, we're trying to decide what overall, on average, a company's normalised profits will be. Not what its profits are today, because it's not doing very well today, but what will they be on average in, say, 5 years' time. We don't say exactly 5 years' time, we just say when it's in the middle of its recovery period. And we say, we make that decision by looking back at history. If typically that company made £100 million of profits for 5 years, we think usually it could make £100 million profit in the future, unless there are some big changes happening in the industry. Alternatively, if our company only makes £50 million, but all of its peers in the industry make £100 million, we might say, well, they've never made £100 million before, but there doesn't seem to be any reason why they couldn't, perhaps under new management, make that £100 million. We then, to get our valuation, say, well, if it is making £100 million, what will other investors pay for it? And our view is other investors, when this company is making a normal level of profits, they'll pay a normal market rating, which varies, but is usually something between 10 and 12 times. So in this situation, this example, the investors may pay 10 times £100 million, which gets you to £1 billion. So the question then is, what can you buy the shares for? And we're typically looking for at least 40 to 50 upside. So if we can buy this company at, say, £600 million, we've got upside of £400 million. And that's our possible profit we could make. Alternatively, the way I sometimes look at it is we can make £400 million worth of mistakes in our analysis and still not lose money for our clients, because our fair value would come down from £1 billion to £600 million, which is the current share price. So we're really looking for that upside. That's our margin of safety. Just to take account of those little errors we may have made or information we may never have been able to access, to try and limit the potential loss we may make on any single investment. So what is our competitive advantage, and why is it important to have a competitive advantage? Well, I think for any investor or fund manager, if you can't work out why you think you're going to be better than your competition, then it's not even worth being involved in the markets, because without that, you've got no reason why you should be able to persistently and consistently outperform. So what is our competitive advantage? Well, first of all, as we spoke about earlier, and some of these points I have mentioned earlier, but I think are well worth re-emphasising. Point number one is to be rational all the time. We're human, we've got our emotions, of course, but if we can be more rational than other investors, particularly at a time when they're being their most irrational, we think that is incredibly important. That's the most important thing. Secondly, is that we're very benchmark aware. What does that mean? Well, we on the UK Special Situations Fund, for example, we're measured against our performance against the FTSE All-Share Index. And therefore, some companies have large weightings within that All-Share Index. So, for example, companies like Shell, BP, Glaxo, HSBC will be very large components of those indices. So, therefore, when we want to be bullish of those companies, when we're very bullish about their prospects, we go overweight their index weightings. So if an index weighting is 5% of a company and we're very bullish, we might take a 7% or 8% holding. So we're very benchmark aware, which reduces our overall risk relative to other ways of managing money, which would be benchmark unaware, where you don't really care what a weighting a stock has in an index. It's very, very important that at the same time, if we don't like a company, we're fully entitled to have no weighting in it whatsoever. So we're not index huggers or index trackers in any way. We're just aware of what the benchmark looks like. We've also got very, very long holding periods. With some of the stocks in the portfolio we've held for 10 years or more. Our average holding period is now over 5 years. And we think that's good because it's an uncompetitive pool that we're competing in. It's the pool which most investors are competing in is one where holding periods of 3, 6 or 9 months. Everyone is looking at those ideas and those stocks and desperate to find an angle on why those stocks might perform better, make their money very quickly and then move on to buying another stock. We're looking in stocks you've got much longer recovery periods, and where other investors haven't got the patience to hold the stocks for that long. They think if they buy into the sort of stocks we're looking for, they're at risk of having dead money on the portfolio, having stocks which don't move for 2 or 3 years, or even worse, go down for 2 or 3 years. We simply think the competition in the short holding period sector, if you like, is absolutely intense, and we think it's much harder to identify your own competitive advantage when you're competing against so many people trying to do something very similar to yourselves. Also, we have, as I've spoken about before, a mix of different companies on the portfolio. I always compare our portfolio like putting together a wine cellar. We've got a lot of different wines from a lot of different regions, bought at different times, and they'll all be maturing at different times. What does that mean? If you've got a wine cellar, it means if you invite your mate round for a drink, they're never going to be able to drink you dry on one night. They'll be able to laugh at a couple of your bottles, which are now tasting like vinegar. They'll be able to have a nice couple of bottles, which taste fantastic, and you'll have to say to them, sorry, you'll have to come back in a few years' time for these other bottles because they haven't matured yet. That's what our portfolio is like. We've got some stocks that are doing well, some stocks that are asleep, and some stocks that are doing badly. Well, that's fine. They tend to just about cancel each other out. When the stocks that are doing well reach our fair value, we sell them and we refresh the portfolio by putting them in new stocks that are out of favour, or we add to our current stocks which are out of favour. What does that mean? It means we're not betting on just 1 or 2 factors for our portfolio to do really well. We're not betting on, say, the economy suddenly being really strong or the market suddenly become really weak. We've got a mix of different bets on a portfolio. Rather like an insurance company, well, they've got lots of different motor insurance risks on their portfolio, from little old ladies to boy racers, and they love that mix because they know that makes them less susceptible to any one sort of driver. This deep fundamental analysis we've spoken about before really contrasts our approach to a lot of other investors' approach. It simply takes us four weeks to write our notes. We're very, very slow moving, but these notes are very different from your average investor, and as I say, have got a very long shelf life. We focus on enterprise values. What do I mean by that? That means we look at the market capitalisation of a company, so its share price times the number of shares. But we also look at the debt of a company and its contingent liabilities. So it might have large pension deficit, it might have other provisions it's got on its balance sheet. So we put all the nasties in there as well. We don't pretend those nasties don't exist. We add them all to the market capitalisation of the company. We effectively pretend as though we're buying the whole company, albeit a small percentage of the whole company, and therefore we're taking on the company's debts as well as its equities. And we're also very downside aware. We don't go to bed at night thinking how brilliant the company we've bought is. We go to bed at night worrying about the company we've bought. Why is someone else selling us this share? If it's as cheap as we think it is, why on earth are they giving us this fantastic opportunity? Have we missed something? Have we underestimated the importance of something? We're always trying to work out why the smart person who sold us that share, what are their reasons for doing it? If we can understand their reasons, and we might be happy opposing them. If we don't understand their reasons, it's more likely we've made a bad decision. So all of these factors come together, we think, to provide our competitive advantage. So what makes us different from other contrarian investors? I think each of the points I'm going to go through is a small difference, but when you add up all the differences, what you get is a result of us being very different from most other investors. A lot of these, once again, we've mentioned before in passing. I'll perhaps bring them more to life on this point. The first point is patience. We've got huge patience. We'll wait for shares to underperform over 7 years. That's a long time to watch a share fall. We then, if we do buy them, and very often we don't buy them, we then hold them for between 5 and 10 years. We do an extraordinary amount of sitting on our hands, we don't deal very often. Sometimes we may only buy one new stock every quarter. If we don't buy a stock in a quarter, that's fine. It's a bit of a strange existence. We have to go home and tell our other halves we've done nothing all day for every single day for a quarter, but that's fine. We're only waiting for those really fantastic investment opportunities. And as I said before, it can be compared to going to an exam. We can go to an exam, we look at the questions. If we don't like those questions, we leave the exam hall and we come back the next day. We only deal when we want to. We're not forced to deal all the time. I think that's a brilliant luxury in fund management, and we make the absolute most of it. The second point is valuations. We really want to focus on those cheap stocks which are cheapest in terms of how their enterprise value compares to their normalised operating profits, and we've spoken about that before. This area of extreme out of favourness, I think, is worth coming back to. Only investing in stocks which have fallen by at least 50% really gives other people the heebie-jeebies. A lot of people do think that if you're down 50%, your next stop is down 60, 70 and 80. And they believe that share prices are talking to them, that if you're down 50, there's only one way you're going from there. We don't believe we are playing with fire. We do an extraordinary amount of balance sheet analysis on the companies we're looking at. We really spend a lot of time looking at the industries they operate in. And most important of all, we're very, very happy to turn them down and say, no, that's too risky, or we're not really sure. So we love this area of out of favourness that we focus on. Another point is we are just purely bottom-up stock pickers. That means when we're building a portfolio, we're just trying to build it up from looking at individual companies. And if we can find 30, 40, 50 individual companies which we buy, that creates the portfolio. We don't have any top-down view. We don't bring any economic overlay to the portfolio. We don't say inflation is going to be 5% per annum, or economic growth is going to be 3%, or interest rates are going to be this or that. Why don't we do that? Well, firstly, because we think it's very difficult. Economists haven't got a great track record. If you don't believe me, find a copy of the Financial Times from 5-6 years ago and see how many were focusing on an economic recession. Not many is the answer. Even if you are good at economics and have a good track record, what do you do with your results? There's no rule that says a particular stock will perform well if inflation is 5% per annum or economic growth is 3% per annum. So we don't think there's anything great to be gained from being a top-down investor. And you remember what I talked about having lots of different bets on the portfolio. If you're a top-down investor, your portfolio can be very skewed to a portfolio that you think is going to benefit from consumer spending or cuts in government expenditure, etc. It's a far more risky portfolio. We also are market agnostics, which means we've got no view on whether the equity market's going up or going down. Quite simply, once again, that's a harder question to answer, so we try to avoid it. And also, even if we knew which way it was going to go, then we wouldn't necessarily have a different portfolio. We don't think there's certain stocks which always perform well when the market's going down, or always perform well when the market's going up. As I said, very downside aware, and we've covered that in enough detail. We're really focused on long-term performance. We haven't really spoken about that much. It's our 3-year, 5-year and even 10-year performance, which we're most proud of and focused on. We don't really worry too much about our short-term performance. What does short-term performance mean? Well, in these days of technology, you can look at your performance by the second. That's quite clearly random. A day, is that random? We think it is. A week, a month, we think these are very, very short-term periods. But other investors are always looking to outperform over those short-term periods. Interestingly enough, over our many years, our short-term performance is no worse than anyone else's, even though we don't worry about it at all. And the final point is we're always looking to get better. We're always looking to evolve and improve. And it's very interesting. When I was doing some research for this presentation, I read that when Tiger Woods was the world #1, during that period, he remodeled his golf swing twice. Which I thought was absolutely extraordinary, because when Tiger Woods was his absolute best, he was mile ahead of the number 2 and 3 golfers in the world. But he was obviously still racked by neurosis to such an extent that he felt he had to keep trying to improve his golf swing and remodel his game. And I think if a genius like Tiger Woods feels he has to always improve, there's a very big lesson for the rest of us mortals.
We hope you now have a better understanding of contrarian and value investing. We hope that you now also have a better understanding of the role of balance sheet analysis in constructing portfolios which contain a diversified basket of quality out-of-favour stocks, and how this type of investing offers the potential for long-term outperformance but with lower volatility. We hope you found this session useful. Thanks for watching.